subscribers. I want to bring you a special off the beat announcement and answer some questions that I'm getting. So, if you watched this morning's episode, you know that we made a huge call with Philip Morris this week. We said that we advised, or not advised, we said that we were going to be purchasing some longs of Philip Morris. We thought that they would beat earnings expectations. Remember, we are not a financial advisor, so make sure you do all your due diligence in researching your own stock trades. We're just sharing about what we think about the market. However, I want to share a little bit and answer some questions around how did we find Philip Morris, and then how did I trade on this? Now, this is my own personal portfolio, and the exciting thing is, as of 10:05 this morning, I had grown my portfolio by 19% on this trade. So there's two things that I did with this. I bought some option contracts, as well as I bought some just actual shares of Philip Morris, and that led to some pretty phenomenal gains. Again, as of 10:05 on the options contracts, I was up about 400% on those, 420%, and then I sold those. So was able to realize the gain on those. And now, as far as just the actual shares of Philip Morris, holding those, they're up about 5.5%. As of, again, 10:05. So how did we find this trade? So first off, if you're paying close attention on Foliko Live, you're going to find these trades. It's going to pop up, and this will be obvious. We're making this clear to you and everything like that. But second off, really, to go deep into this, you need a subscription to Foliko. This is how we're sourcing these trades. So there's a couple things that we did. First, we knew that Philip Morris was releasing their earnings this week. So we have a few different kinds of models to come in and understand what kind of position or what kind of opinion we're going to be forming on this. So let me start sharing my screen to share the basis of how we arrived at this conclusion. So here we're at the Foliko homepage. This is, again, we use artificial intelligence to read all the news around the world so you don't have to. And we use that AI, the advanced natural language processing techniques that we have, to understand what people are saying, to benchmark against what they've been saying about in the past about the company, the sector that the company operates in, and the market overall. And then we layer on top of that some additional AI algorithms to draw a line through all that data and understand where is this going in the future. And so how does this translate? Well, I can come out with a view on how sectors are doing. And if you watch this morning's episode, you'll know that we have a pretty warm feeling about this consumer defensive piece, especially given, there's some recession red lights flashing right now, and consumer defensive is going to be a good bet that the market is going to head into that recession. These are companies that tend to do better in recessionary periods. So great, we have this initial investment thesis. We're starting to see this divergence between the green and the orange line. The green line being the market, the orange line being the sector, and then we see that sector charging forward from our AI algorithms. But now we can go in and dive in on a ticker by ticker basis. Now we have 6 different health scores. One of these health scores that we have is called earnings power. In other words, from reading all the news articles, hundreds of thousands, millions of news articles around the world, we're able to extract out these 6 health scores to understand how a company is performing along these different dimensions: competition, management. One of them is earnings power. So if I leave my mouse over it, you can see exactly what this is. It's the financial results and track record of this company. Now I can sort all the companies in consumer defensive by how well their earnings power is doing. And if you see what rises all the way to the top, Philip Morris. And that was initially what caught our eye. Okay, this week, Philip Morris is releasing their earnings. They're at the top of a sector and stuff like that, a sector that is doing well. So now we can go into the company itself. Now, one thing that I'm going to point out is, absent the earnings season, there's not really any big red flags on our AI models predicting a downturn for this company. It's just kind of moving laterally over time, especially given the context that for the past couple months, Philip Morris has performed quite poorly, about even given from March to now. So not much to say in terms of strength or weakness in the stock in year to date. And the AI models themselves aren't predicting any big motion back or forth. That's actually a good thing for us, because once we then start layering on expectations around this specific earnings event, that's going to be a powerful indicator for us. Now we come in here and we see what the earnings power specifically is. Now this is Tyler Tucci. If you've been watching our show, if you've been faithful getting these insights over time, you'll recognize the alligator jaws of opportunity. Now, right here, what we see is coming into an earnings event. Whenever you see a divergence between earnings power and stock price, this is something you want to pay attention to. And look at how clear of an example this is. This is amazing. So we see the stock price really diving down into low 90, which means you're getting some great value here at a lower price. And that earnings power score charging upward, charging higher. And now what we have here is some arbitrage that we can take advantage of, which is why at the beginning of the week, when we made the call, Philip Morris, something to watch around this earnings season, we're going to come in and see some great appreciation of the stock price. That's when I came in and we were able to make that estimate that for me, it was $95 as the right strike price. And so I was able to snatch up some options contracts around that stock price or strike price. And again, that I just exercised, that was up around 400% each of those contracts. Fantastic. Able to realize that. I also went long on just some shares in general to get the upside from that. So, and those are up as of right now about 5.5%. So fantastic day for the portfolio, but this is not just for me. We are trading our data. We're trading on this platform right alongside you. But I wanted to share with you the process of how we're able to achieve this strong gain. And for all of our subscribers that are on Foliko today, remember the exciting announcement that we just gave out this morning that you're going to be getting in your inbox every day a full list of all of our earnings predictions, every company on our coverage list. So included in the price of your subscription is going to be this extra data set. Now, what did this extra data set say for us today? Well, first off, there's a couple really cool things that you can do because this data set includes not just tickers, but also sector and industry. It indicates when the expected release date for those earnings are going to be. But look at what happens once I start analyzing this from a pivot table perspective. And this goes back again to how we're able to form an investment thesis on a sector by sector basis. And so we have here utilities, technology, consumer defensive, and look at the average difference from market consensus. We can see at the top, actually, this is a pretty bearish view of the market and its earnings cycle overall right now. It means that we're probably facing a lot of headwinds on earnings this cycle, especially as compared to expectations. But utilities is actually rising above. Consumer defensive, again, floating to the top of what we would expect. Now you can see our mean absolute error here. That means that on average, how much are we off on our predictions? If you take market consensus is off in their predictions about 55, 56 cents each time, each earnings cycle. We're off, and we've broken it out by sector right here. So on the consumer defensive, we're actually shooting really far below what market consensus error usually is. Always something to keep in mind. Once you get to energy, actually, energy is the one where on our earnings predictions, the street does really poorly, and that's where we have our least accurate results. But it's always good. We include that in with this data set so that you can form an opinion on what you're going to like for that earnings per share. So we come in and let's take a look at just PM, Philip Morris. So we come in and we see their last earnings per share was $1.50. Our models, our AI models were coming in and projecting $1.32 on their earnings per share, whereas the street was coming in on $1.23. So what does this mean? This means that they have a bit of a fall in profit from last quarter, but at the same time, not as bad as what the street was projecting, which means that their price had sunk lower on expectations that were too low. And so given that we saw the alligator jaws, we see some really nice views coming in from our AI models on the earnings per share predictions. We're able to come in and help that portfolio grow 19% in one day. How's the rest of the S&P doing today? Let's look that up real quick so we can get a benchmark. S&P is down 0.5%. Whole market is down 0.5% right now, and I'm riding this wave of up 19%. By the way, this isn't the only time this same story is playing out. We're seeing the same results on our Tesla model. Tesla, we got the earnings right. They're up a very significant. I mean, the NASDAQ is floating on top of basically just Tesla right now, which is why the NASDAQ is a little bit above the S&P 500. So look, you're not going to want to miss another earnings cycle, especially right now. There's such an enormous opportunity. This is an extremely confusing market. You know, and if you're expecting to compete with the big guys, expecting to compete with Wall Street, which by the way, as of right now, Philip Morris and Tesla have almost exactly the same percentage change. We had the same call on each of them. So Philip Morris up 5.69%, Tesla up 5.75%. It's wild, right? How do you expect to compete with the big guys? How do you expect to compete with all the money flowing around Wall Street? Which, by the way, no disparagement towards Wall Street. A lot of those folks worked very hard to be where they're at. So awesome. Bully for them. But what does that mean for you? Well, you can supercharge your portfolio today by purchasing a subscription at Cinerai.com. Cinerai.com. The link to get there is in the description below, but you don't have to take my word for it. Right now, we're offering a 1-week free trial so that you can come in and get all the benefits of everything we're talking about. You're going to be able to get in and get those earnings predictions, and we're going to have exclusive subscriber events for you to be able to ask questions, get our perspective, understand how we built the models, and now you would be able to go out and build your own models on top of that. Beat us. We absolutely invite all of our subscribers to energize their portfolios as much as possible. So come in, subscribe today, and we'll see you on the flip side. So thank you all for joining, and I hope you have a great day of trading.